Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. There's a lot to go through here, even more now than last time. So I've often mentioned how the bright green highlighted August 2022 to date uptrend, currently at 19.25, how it did not act so much as a support or a resistance, but more as a nuisance. In the middle to end of August, just before we ran into the changeover gap, prices started their most recent journey higher. Over the 21st century 50% Fibonacci line at 1809, then over the 50% Fibonacci line for the April 2020 to November 2020 move at 1859, and then tackling all the moving averages, and then the nuisance that is the bright green uptrend, and then the nuisance hit in late August to mid-September when this bright green nuisance caused the market, I keep calling it a nuisance, I'm sorry, caused the market to turn and dip and then turn back up again, creating a bullish halfway hesitation. Soon after, we saw the topside targets, both primary and secondary targets, reached. The move up over the March 2023 low at 2004 started the next phase of the market's rise. Now, we'd seen rejection there at March 2023 low weeks before, which, to be honest, looked at the time like long liquidation ahead of the long weekend in the US. Now, I did put out there some 12 weeks ago that the action since mid-April might be forming a possible double bottom. This pattern looked for a while that it may not complete or even give a clue as to the direction of it or its validity even, and I've stated that we would need to see how the action developed there. I've been very clear on the wording I used when I said on this point 12 weeks ago, and I quote, "Please note this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine but definite." End of quote. This did not take away from the far smaller August-based double bottom, which saw its top side fulfilled during late August and early September. So the rally continued, with now a bullish halfway hesitation, and 5 weeks ago explosively reached the topside target for this pattern at about 21 even and triggered the previously mentioned double bottom pattern. This had a topside target in the 2340 area, which was reached 4 weeks ago. In the process of rising, the market also created the opportunity for two quite large patterns, or should I say one final pattern that may come from two possible developments. You see, the action since roughly January/February this year till now has set up the opportunity to be either a bump and run reversal pattern, typically a bullish pattern, but it is prone to throwbacks back down, or the alternative is a descending scallop pattern, a pattern that could be seen as either bullish or bearish on a larger scale, and very much depends on what the market does now between the recent high in late September and the low seen in early September at the very least. If the market stabilizes, then prices could head significantly higher. If not, then significantly lower. However, these patterns are still not fully formed, though they have been formed enough for me to categorize the actions this year as being one or other of these two. Of course, further patterns could develop from just features, and I would like to discuss some of these features. So, this all deals with the very recent action and approximately between mid-September to date. There is a choice, somewhat delayed, but a choice nevertheless, that the market may need to make. This action first featured as a possible double top pattern, but the action over mid-October has countered that idea, and I'll retire it after this commentary. The second feature is to regard the very recent action as a possible three falling peaks pattern. Now, I spoke about this pattern last week when I said, and I quote, "This pattern depends on one key feature, and that is closes below the low of last week." So that is now 2 weeks ago. Below the low of last week at 2177. If we do have confirmed closes below this, then the opportunity is for a drop down to the primary potential, not a target yet, but a potential down in the 2130 zone, with a secondary harder to reach potential in the 1985 zone. The importance of this pattern is that development of the secondary harder to reach potential could influence the choice of either a bump and run reversal bottom or a descending scallop pattern. I must stress again that the potentials for a possible 3 falling peaks pattern is still just potentials, but ones that should not be ignored. End of quote. Well, last week prices did penetrate 2177 on the downside, but so far there has not been any closes below it. So this all still lies open as a possibility. The second feature is to regard the mid-September to date action as a possible bull flag type action. This, much like the earlier one, is still open as an idea, as the market has neither started rising and confirming this idea nor falling and discrediting it. Then there is the more recent idea of looking at the very late September to date action as a possible descending wedge pattern, currently 2163 to 2278. As a pattern, this is fairly advanced, but as yet we have not had a breakout in either direction, though we have had minor breaches both above and below. So as you can see, we have 3 distinct features in the very recent and very recent action, but as yet no moves have been made to verify or discredit any of these, bar the double top, of course. I continue to watch this market carefully. Ice Europe white sugar in London. When looking at the action over recent months, I had emphasized in the past and wish to emphasize again today some significant points. First off, the monthly key reversal down in July. This helped move prices lower until the middle to end of August. 12 weeks ago I spoke about a new pattern, a start of July to end of August bear channel. At the turn of 8 weeks ago into 7 weeks ago, prices punched up through the top of this bear channel, giving some opportunities on the top side, which were duly achieved. The move up to achieve these targets was caused by the construction of a mid-August to mid-September bullish halfway hesitation, with an integral horn bottom that also achieved its own target. The action over late September has forced yet another pattern and resurrected an old one. The forced pattern is a lopsided island pattern with the 2 gaps seen 5 weeks ago, since filled in, and 3 weeks ago, which is still a live gap. However, I should add, it is not a great looking island pattern, not by a long chalk. For starters, the gaps don't line up properly, but it's still out there, and I'm still watching to see whether the action since then justifies it. So far, it really hasn't, though prices have tried heading lower, and by its nature, this island pattern is a bearish pattern. However, as I said 3 weeks ago, and I quote, the opportunity for the downside is limited to perhaps where the flatlining medium moving average is currently, that's 55.51.10. End of quote. Now, I also noted 3 weeks ago, and I quote, the capping action of the slowly declining gold long moving average right now, currently at 581.20, end of quote, which is still there. And I also continued, and I quote, the resurrected older pattern is the late December 2023 to mid-April 2024 descending triangle. This pattern showed its swerve back in April through to early August when the market broke down through the base relatively early on and reached, eventually, both primary and secondary targets below. I have once again highlighted this pattern in dark blue as the market reaches the apex of the descending triangle this week in the 605 area, so that's a few weeks ago now. End of quote. All this rejuvenated bearish pressure after a reasonable run-up from mid-August would, I warrant, deserve keeping a wary eye on any moves lower, as we have a couple of fairly free areas, one of which we are in now, or just about now, down until the February 2017 low at 565, which we are testing at the moment. And then down to the 550.20 to 546.90 congestion, where we find the March 2017 high at 548.70 and the previously mentioned medium moving average. This would see a reasonable pullback after the summer rises, but anything of note beyond that on the downside, then we'll have to look again. Meanwhile, please also keep an eye on the top side, as sooner or later something has to give, though it may not be immediately.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.
you.